Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
All right, welcome back to day 2 of our special coverage from the 27th Annual Milken Institute Global Conference here in a very warm Beverly Hills, California. A mashup, once again, of 2 of your favorite programs. I'm not going to say which one is their favorite, but it is a mashup of The Close and Bloomberg Businessweek. I'm Romaine, Bostick.
I thought you were going to say 2 of your favorite talents, but I didn't want to go there. I'm Massar, everybody.
That's Tim and Alex Steele. Is that?
Don't tell them. All right, we spent a lot of time yesterday talking to folks from the world of private capital. Today, we're going to expand things a bit with a broader cross-section of finance, including sitting right next to us, Carmine Sibio. He's EY CEO. We're going to talk about some of the big changes in the world of consulting. I'm curious, though, what CEOs, what they want to know from him, right, and his team about what's top of mind for them.
A lot going on in that space. A lot going on in the media space as well. Byron going to be stopping by to give us his thoughts here on that long shot bid for Paramount.
I'm really excited, too. We're going to talk a lot about real estate today. David Steinbach at the real estate investment giant Hines to talk single-family rental strategies. They have such a great global perspective, so curious to see what he has to say.
Katie Koch, CEO over at TCW, going to be stopping by, as is...
Wait, and they had some news yesterday.
Oh, yeah, that is right. We got a lot to talk about.
In the private credit space.
Someone did show prep. All right.
Also with us, we're going to check in with Ray McGuire, president of the investment bank Lazard. So that's going to be pretty cool.
And then a guest I know that you've been really excited to talk about. You're really into this neuroscience stuff.
Yeah, exactly. Dr. Ali Rezai, he is over at West Virginia University Rockefeller Institute. 60 Minutes just did a piece with him, so fascinated to see what he has to say. And we're doing this on a day where we see the markets up again, S&P popping up above 5,200.
There's a lot more optimism. When we talk to people, there's a lot more optimism, whether it's in public markets, private markets, deal making, consulting, maybe?
Well, that's what we're going to find out.
Yeah.
Listen, we often talk with disruption or about disruption here at Milken, investing in business and technology. It is also happening, as Romaine just said, in the world of consulting, where firms have trimmed headcount, delayed start dates, and slowed the pace of hiring over the past year amid declining demand from their clients. So we have a great voice to talk about the industry and changes at his own firm and more broadly. Carmine Sibio is global chairman and CEO of the consulting firm EY, here with us at Milken. Thank you so much for being with us.
Great being here. Great being here with both of you.
Let's start with the headlines. You know this industry. You started at the industry, at EY, out of college back in '85. The headlines, cutting workers. It feels like that they are pulling back in a big way. What is going on in the consulting industry?
Well, first of all, you got to step back a couple of years ago. We were all growing at above 20%. EY was growing above 20% in consulting.
Because of the pandemic and that part?
Well, there was some pent-up demand from the pandemic, but also there was confidence, low interest rates, which I'll get into, and companies were spending. Okay, now what's happened with rates going higher and there being uncertainty in terms of where rates are going, companies are holding back on spending. And it's a little bit more of an expectation versus where the rates actually are, because historically speaking, the rates are not that high, but the expectation was cut at a certain time period. So I think companies have been waiting and therefore not spending as much as they were. And that's caused a slowdown. It's an industry slowdown. We were growing well into the 24, 25%. Now we're growing in the mid-single digits.
How much is a cutback on the private equity side of things? You guys consult a lot of the PE firms. We talk to a lot of PE. Here, they are kind of finding their way forward. How much of the slowdown is a result of that?
Well, it is. Some of the slowdown has to do with transactions, whether it's PE or strategic transactions. There have been less of them. Obviously, the overall economy and rates have impacted that. When there's less transactions, a lot of our businesses are slower. Our transactions business, our due diligence business, even our tax business, and certainly consulting, transformations, integration, there's less of.
So volume is down. What about the size of deals that are getting done? Are those also lower?
They're also lower because obviously big spends, huge technology spends that are in the hundreds of millions of dollars, they're expensive. companies have held back in terms of really investing the way they were.
What sort of, I guess, provides a boost to that space? Because we talk about interest rates. I mean, interest rates have been stable, relatively speaking, for the last year now, I guess, more or less here. And most people pretty much assume we're pretty much going to stay here, maybe some tweaks around the edges.
Yeah. So a couple things that will give it more boost. One is AI. So companies right now are looking at how do they deploy AI. And we're at the very beginning stages of generative AI. So when people say, oh, AI's been around for 20 years and so forth, machine learning's been around for 20 years. Generative AI, at the scale that it could be, has not been around for 20 years. So we look at AI in 3 different buckets, and this is the way we really have our clients look at it as well. First of all, you have to look at it at the strategic level. Your board, your CEO has to know what AI is going to do to your business. It can't be just your chief information officer. But we look at, number one, is how do we help our clients with AI? So that involves a lot of use cases in different sectors around the world. We have thousands of use cases that we're working with our clients, but these projects are small. We're getting used to them. Yeah. The middle bucket is around how do you make your business better?
Right.
And that includes us as well, and that's around productivity.
You tried to make the business better by spinning off the consulting unit. It didn't happen. Are you disappointed in that it didn't work out?
I am disappointed, but the reason why we're doing it, the conflicts in terms of really unlocking value, is still there. So I truly believe we've learned a lot from that process. The profession overall has learned a lot. You've seen private equity now investing in accounting firms and consulting firms. They weren't before because they're seeing the cash flow and the value, and you're also going to see that going forward.
Carmine, I wonder, like going through your own restructuring and issues, if you will, at EY, does that help you in terms of working with clients? Or does it make them say, well, wait, you guys sound like you've got some stuff going on? Like, I'm curious about that.
No, it was incredibly helpful. We were going through this transformation, and we learned a lot, and we've changed a lot, even though we haven't done the actual transaction. But I was talking to CEOs that were going through transformations, comparing notes, helping each other during the entire process.
I do want to go back to AI, because obviously that's been the talk of a lot, and specifically how companies build those AI strategies. The idea of, do you build it yourself, or do you just find another company that's doing it and buy them? What type of questions are you getting from clients about the best approach to take?
Well, I think companies right now certainly are looking at companies like Microsoft. Microsoft has this concept called Copilot, which helps in a lot of different areas, but it helps an individual in terms of their work every day and so forth. And so, Microsoft's doing this at scale, others are doing this at scale. We have an alliance with Microsoft, so it's really helpful to use others that have invested in this for those kinds of tools. A lot of companies are asking about developing their own large language model for their company using their data. We have one of those at EY. It's called EYQ. It's fantastic. Our people love it and so forth, but you have to have cleansed data to be able to do that.
Yeah, absolutely. And to start off, Carol gave away your age by saying when you started out there, but it was actually kind of fitting because we talk about these big. He did finish. Yeah, he was an overachiever. But it gets to this idea of these big structural changes, right? You're on your way out as a CEO. You're handing over the reins in a couple of months, I believe, right in July. Yeah. Here, what are you leaving your successor? I mean, what are the big issues that you think she's going to have to deal with that are going to be most important to build EY?
So let me just go back for a second. When I became global managing partner, which is the #2 role at EY, it was 2013. We were $25 billion in revenue per year, and we were about 200,000 people. We're $50 billion now with almost 400,000 people. So there's been tremendous growth in the organization. My successor, Janet Troncalli, she's an absolutely fantastic
leader.
First
woman CEO.
First woman global chairman and CEO of a Big Four firm. And she will have a huge scale of a firm to run. And she will have to wrestle with what's the strategy going forward? Are the conflicts too great? Do we have to relook at transactions? Do we have to look at how do we create value, private capital being invested in the business? These are all things that not only her, but all our competitors are going to have to look at.
It's interesting you talked about the growth of EY, but does it need to be leaner in some ways going forward?
It absolutely does, and it will be leaner because of AI. technology will help it be leaner. We're looking at 20-30% productivity help as soon as we get all the technology in, and so it will be leaner. Our partners are asking for that. Technology will be a big help.
Is that technology, though, that's primarily doing a lot of the sort of more rote tasks? There's been a lot of discussion about entry-level jobs in this space, whether it's in consulting or investment banking, the types of tasks, rote tasks that were given to those new entrants. If AI or some other technology is doing that, what type of training are those folks, those new folks, going to have as they come into the industry?
They will have training in AI. They will have training in AI tools. We already do that. We offer many hours of training. That's one of the big advantages of starting at a firm like EY. It's training. Some people think it's the continuation of school. We train. If you look at corporates today and you look at finance functions in corporates, many people have had a start in one of the big four firms. And we really train the world when it comes to finance, accounting, auditing, and so forth.
Carmine to Sibio, thank you so much. We really appreciate it. Good luck with all that is to come from you.
It's great being here with both of you. Thank you.
Really enjoyed it. The CEO of EY joining us right here at Milken.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Now alongside Byron Allen, who founded Allen Media Group and Entertainment Studios in the 1990s. He expanded it from a few late-night syndicated programs to ownership of more than 36 broadcast network affiliates, a dozen individual properties, including the Weather Channel, as well as digital news platforms like Boro. He's recently added a movie distribution company and has gone public with proposals to buy local TV giant Tegna in 2022, a pitch to buy ABC and Disney assets in 2023, and this year, interest in bidding for Paramount Global. Byron joins us right now here from the Milken stage. You're always bidding on something, Byron.
As a matter of fact, I'm going to bid on this flower on your lapel right now.
Well, my wife thanks you.
Okay, I'm thinking $1 billion. What do you think?
I'm going to say $30 billion.
Okay, I'm out.
According to Bloomberg Intelligence, that's the amount that you are prepared to put up for Paramount. Are you interested in buying Paramount? And if so, at what price?
You know what? We remain interested. We think it's a phenomenal asset. And we think Sherry and our management team, they're well positioned to continue their path, or if she wants to sell, we're happy to help. And I have a lot of faith in Sherry Redstone, and I have a lot of faith in George Cheeks and Brian Robbins and Chris McCarthy. They are excellent managers, and if she decides that's the path she wants to take, have them run things, that's great. If she's still interested in selling, we are very interested in sitting down to figure out if we can get something done. A lot has occurred over the last 6 to 8 weeks. Events that we're not used to seeing happen so rapidly. But we do have strong interest in buying all or some of Paramount Global.
Do you think your bid can be competitive, both in terms of what it offers strategically as well as the financing to do it?
You know what? Capital is not the issue. There's plenty of capital available to support our bid and to buy the asset. The real commodity here is certainty of close. And the great investor Mario Gabelli said it best. This deal will live or die at the FCC. My advice would be to walk into the FCC with somebody that is FCC approved,
right.
Somebody who owns and operates television stations.
Do you think Sony can do that?
Well, when you are a foreign owner, that's tough to own television stations. I think you can own up to 20%. They don't allow that. So we've invested about $1 billion buying ABC, NBC, CBS, and Fox affiliates around the country. We are broadcasters first, and we are FCC approved. And that is the key to this deal, approval, regulatory approval. There's plenty of capital. Just in this lobby alone, there's about $80 trillion looking to invest in something. As a matter of fact, I can step off this podium and raise another $30 billion in about 5 minutes. Yeah. Just go talk to her, him, and her, and we're over. Well, so capital isn't the issue. Yeah. Approval is the commodity. Yeah. And that's the thing that everybody needs to be mindful of. Yeah. You want to be respectful of the process. I don't think you want to go into D.C. saying, I've never owned and operated television stations. Yeah. I think that's important.
Byron, having said that, it sounds like you're pretty far along in the process. Do you have bankers lined up? What can you share with us in terms of who you're working with when it comes to, as you say, lots of capital out there. So who are you working with in terms of lining up the financing to actually do a deal?
Well, that I can't share with you. But I will tell you this, that the capital is very much available, not just to me, but others that are skilled in this area of buying and running media companies. And I think that's what's going to come out in the whole process. What you don't want to do is tie up the asset for a year or two and not get approval.
How far along are you, though, in actually the specifics on a deal in terms of getting something done?
You know, quite a bit of our capital has already been investment committee approved. So we're good to go in that regard. You know, I think we wanted to be respectful of Skydance and Redbird Capital. They had a 30-day exclusive. And so we wanted to see what the story is and confirm whether or not that exclusivity has expired. We're not, you know, a very smart banker said to me, Byron, you don't have to do a thing. All roads lead back to you. Because there are assets there that we want that others don't. We want the linear networks.
Why?
I believe in the linear network business. Yeah. I think it's the majority of their revenue and their EBITDA.
Yeah.
You know, they're folks.
But you know that's the contrarian approach. Everyone's trying to get rid of their linear operations.
You know, I bought the Weather Channel.
Why can't you make it work?
I bought the Weather Channel 6 years ago, and they couldn't. I bought it from Bain, Blackstone, and NBC Universal. They couldn't wait to give me the keys. And thank you very much. In those 6 years, we pushed up the top line revenue and we pushed up the EBITDA, and we're running the Weather Channel at a 50% margin. So we're very comfortable in the linear business. We believe that a number of these linear assets are running a little heavy on expenses.
Is there growth in the linear business?
Yeah, I think there is. I think the Weather Channel has enormous opportunity to grow. I think you're going to see us continue to grow. People are not, especially in the weather. The weather business is a big business because climate change and global warming is very real.
It's the one thing we check every day.
Yeah, it's the one thing, and I will tell you it's going to be more, I'm not trying to be Debbie Downer here, but the weather is going to be more and more extreme going forward.
That's a good point.
And whenever we have extreme weather, we are pretty much number one in that category.
Byron, because you are so upbeat about the linear TV business, if you will, what is it that other folks you think get wrong when they're all saying this is the time has passed, it doesn't make sense anymore?
You know, a lot of times people just don't see what you see, and that's key in investing. What people want to see is double-digit growth. They're fascinated by the double-digit growth. That's what they're attracted to.
But is all linear television, do you think, can have double-digit growth? Or is there something special about the Weather Channel, as you said, climate change and different things make us want to look at it more often?
Yeah, I think what happens, I think the sub count will come down, but I also think that it will migrate to streaming. You know, when I bought the Weather Channel 6 years ago, you didn't have YouTube and Hulu. So now, you know, there are millions of subs that didn't exist before. Content will be consistent, and folks will always want premium content. They just want to pay a fair price for it. I think what's happening is you're watching the consumer say, I want this content, I just don't want to pay this much for it. And I think you're going to see our content survive and do very well because it's being priced correctly and it's packaged with other content that they're willing to pay for. So we're not worried about that. That's the least of our concern. In the last 6 years, if the revenue was going to go down and if our EBITDA was going to go down, it should have happened in the last 6 years, but it didn't. It went up.
But you're not immune to what else is going on in the world and what's affecting some of your competitors. You just recently announced some cost cutting, some degree of cost cutting. I don't know the exact numbers, but you've had to tighten your belt a little bit as well.
We have approximately, look, I started the company from my dining room table 31 years ago. And in our 31 years, we've never had, layoffs.
You still have that dining room table?
I do.
And you're going to submit that to the Smithsonian?
I'm going to do that. I'm going to submit it. And more importantly, the chairs that were holes sitting there. But we had about 2,500 employees.
Yeah. And
we reduced our workforce by 300. And it was very painful because we've never done that before. During the pandemic, I didn't lay anyone off. Because I didn't want anybody going out into that cold, ugly world of the pandemic. Mm-hmm. Unemployment now has hit a low, and there's plenty of opportunity out there for folks to go and get other jobs and continue to flourish. So that wasn't easy, and our focus now is more on streaming. Yeah. We have Local Now, which is something very special, which is a free streaming service that uses artificial intelligence and provides local news, weather, sports, and traffic, geofence to the user's zip code. And the most important thing here, it's free. The world loves free, and it has over 20,000 movies and everything else.
All right,
do
you're preaching
indeed.
to the choir. Byron, going to have to leave it there. Always wonderful
Thanks.
to talk
Thank
to
you. Thank you for having me.
Byron Allen over at Allen Media. And we continue our coverage here from the Milken stage. And, we talked to him about linear TV. Let's face it, we have a personal stake in linear TV.
Transparency.
So, I don't want to put him on the spot, but he's always been a big believer in this. And he's built a business going in places that other people didn't want to go, or at least they didn't see the value of going there. And that's why I kind of wonder what Paramount ends up bringing to the table if he's able to get it.
And sticking with it. It's not like he's, bought it, owned it for a little bit and getting out of it. So it'll be interesting to see ultimately how the deal works out.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Sean Dobson has transformed regional broker dealer Amherst Holdings into a trailblazing real estate investment platform with a big focus on single-family rental homes, acquiring more than 50,000 homes over the years with a combined property value of $10 billion. Sean joins us now, the chairman, CEO, and CIO over at Amherst Holdings. And Sean, I do want to start off talking about that opportunity here, because there's always two sides to every coin. When there's pain in one sector, that can often sort of bring about opportunities to invest. And you found a way to do that specifically in buying up single-family homes.
That's right. The sector has been very exciting. It's been a little bit complicated over the last 15 years since the financial crisis. But now we're very excited, very proud of the access that we provide to families who are having a difficult time buying in the best neighborhoods in the country.
For this to be a successful investment strategy, you have to have a belief that what's going on in the housing market is structural and will be persistent for some time. Is that the case?
That's right. When we started the platform post-financial crisis, what we realized was that the access to credit was going to become very, very difficult. And now, with interest rates so much higher, the access to credit has become a price issue as well as an access issue. So for those families that are trying to move into those neighborhoods of opportunity, there's really two ways to get there. If you're fortunate enough to have the financial wherewithal to have a large down payment and qualify for a mortgage, buying is an option. But today, that's probably less than a third of families that really meet those things. So at that point in your life where it's time to live in that type of product of 3 bedrooms and a nice school district, you need to get there. And if the capital isn't available, then we supply the capital.
So what kind of deals are you doing in this environment? You guys did find opportunity coming off of the great financial crisis, Sean, really, and it paid off really well. Is there a similar type opportunity? Talk to us about the environment today.
Well, I think it's more subtle, and we're not really worried about sort of a gigantic.
It's obviously not depressed properties now.
Right. So there's really a scarcity of issues, and kind of what I like to say is that you can think about the residential housing market in sort of 3 ways. There's those that are locked in, those that are locked out, and then we have the market itself is kind of locked up. And what I mean by that is we've never seen mortgage rates move so quickly that there's such a large spread between the available mortgage rate and the mortgage that people have. That creates a significant lock-in effect, and that's brought down the float of the supply of homes for sale by a third. This is the largest asset class in the world, and the supply of available homes for sale dropped by a third. It's historic. So then you have the locked out, which are the people that were originally post-GFC, unable to qualify for a mortgage because mortgages aren't available unless you have a very high credit score. And now you have an affordability issue that's brought about by price. And you have a large group of families that are locked out of the buying. And then my third dumb little thing I made up here for you is that the market itself is locked up because the interest rates have risen and investor return expectations have risen, and yet asset prices have risen.
It doesn't sound good.
Oh, it's real estate. You have to be patient.
How do we boost supply? Neil Kashkari talked about this and the concerns about how this plays into the inflationary picture, that there isn't enough houses out there. Yeah. It's pushed up prices, and that has put pressure on inflation, and it's made it stickier.
That's right.
How do we improve the supply of homes?
Well, I think supply is an issue because it takes a long time. So it's zoning,
land,
it's partnership with the local governments, it's land, and 2/3 of the price to build a home in today's market is labor. And the labor costs have been rising and rising, material costs have been rising. So there's not like the easy button here. This is going to be, it's going to take some time, and it's going to take collaboration by everyone involved, including the credit capital markets, to allow that family that doesn't have a perfect FICO score a chance to get a mortgage.
In terms of being able to acquire these properties, what is the cooperation right now with builders? Are they realistic on prices right now, or is there still a bit of a gulf?
The builders are in a very bull cycle for their business. Their business can be a boom-bust business, and they're in a boom because they're the ones that have the land, and they have the build capacity, and they have the demand. There are still a lot of consumers buying and borrowing at these prices, paying these prices and borrowing at these rates to really satisfy the builders' product. Now, the builders have a very difficult time providing services to that entry-level home, which is where we specialize. That's sort of $350,000 home between Charlotte and Texas and the smile of the United States. So they have a very difficult time producing that home at a profit margin.
I do have to ask you, and this there was a great Bloomberg story about kind of the challenges of single-family rental investment. And this probably applies more to smaller players rather than like a behemoth like yourself. But this idea of keeping tabs on properties, dealing with squatters, and other legal issues that come up that can really affect your cash flow here. And you weren't quoted in the story, but Amherst was mentioned in it. I know this is something you guys have had to deal with.
Like at the end of the day, we manage one home in one neighborhood, and we're providing services to one family, and you have to get that right every day. So if the water doesn't turn on, if a squatter is moved in while it's in the marketing, we have to solve that. Now, we have 1,000 people across the nation focused on the issue and automation and a lot of software. We don't get it right every time. We get it right a lot more often than we don't get it right. But that's the nature of the business, and for us, that's the opportunity. This is a complicated business, and not everyone is well situated to tackle it.
So what is the opportunity in today's environment for you?
It's really, for us, it's expanding the access to capital so that capital really understands they're supporting the renter. Renters are important. It's always been a third of our economy, so we need to give them better choices.
Right.
So I think that's the opportunity to expand the access to capital. And we build a lot of homes, and we're building homes in factories. So it really is the demand. We're very different than a lot of real estate sectors. We have really high fundamental demand. So for us, it's about building more efficiently, building in a higher space, renovating more efficiently, and then getting investors comfortable that this is the thing to do, to support these families and get them into these neighborhoods.
Longer term, when we talk about housing supply, the mismatch between supply and demand, whether it's on the rental side or on the purchase side here, do you see a moment, I guess, 10 years out, where we will see meaningful equilibrium there, or is that just a pipe dream?
It's funny you mention this, because a year ago we were looking at the fertility rates in the United States and forecasting out a decline in population, and that would be one way for this to balance itself. Then we have 3 million new immigrants in the United States now in a year and a half. Those are people that are going to put more demand on housing. So the housing market is going to deal with a lot of confluence of where the demand comes from and where the supply comes from. But what's really important for policymakers to think about is, like you said, this is a 10-year plan, a 15-year plan, and you have to be out in front of it. So cities have to operate in the way that people want to live there, so they know that 10 years from now they have demand.
What about geographic rotation? Does that not help at all?
It helps a little bit, but what we've seen is people leave the core, the big cities, the gateway cities, and move to these smaller cities. And the smaller cities are sort of bursting at the seams in many cases.
Everybody's going south, aren't they? Everybody's
more sun, maybe less taxes.
I was in Nashville, North Carolina. Have you ever tried to drive through there as of late? It's like driving down Fifth Avenue.
Everybody's in the Carolinas.
Exactly.
Sean, thank you.
Thank you, guys.
Sean Dobson over at Amherst Holdings. A nice look, really, at the residential real estate market, and more importantly, the investment opportunities in it.
I think it's so interesting, like coming off of Neil Kashkari and talking about, the shortage of supply of housing, what that means for inflation, talking with Sean, who's in the thick of it, and talking about some of the dynamics that's needed to come together to be able to build out the supply.
And how data-driven that Amherst has been in this. I mean, you talk about them being a pioneer in that space. You're really taking something that's very local, very by the gut, and applying real data to it, and I guess that makes it a better investment.
Great insight.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is a company that's in the middle of the AI play, but a software company. And Thoma is one of the largest software-focused investors in the world. So we're going to talk about the software space right now. They've got over $138 billion in assets under management as of the end of last year. So let's bring in Seth Boro. He is managing partner at the company. Seth, great to have you here with us.
Thank you so much for having me.
When you see the results of Palantir, what do you think? Does it mean anything in terms of the software area, AI-related or other?
Our view on software is that it is an incredible long-term space to be invested in. And what we're seeing right now, at least in our portfolio, is that this next phase of AI, Gen AI, which of course we're talking a lot about at this conference, is driving all sorts of incremental, interesting use cases for our portfolio companies' customers. And the innovation we're seeing is pretty incredible at the moment.
What kind of software, AI related, are they specifically looking for?
For us, where we see most of the innovation, it's organic inside of our portfolio today. So we're buying within software the most innovative companies in the sectors that we're focused on.
What does innovation mean, though, the AI space? Because AI on its own is kind of innovative, right?
The thing about AI that's so interesting is that it has been a foundational technology in cyber and infrastructure software for the last decade. Today, we've now find ourselves in the Gen AI phase of AI, which is the next phase, which is all that we're talking about. But fundamentally, AI has driven all of our cyber portfolio and application and infrastructure portfolio to be able to operate at scale and do really incredible things. Today, what we see is that our development teams inside of our portfolio companies are now leveraging this next generation of artificial intelligence with Gen AI to really deliver incredible applications to their customers.
So is that sort of the investment opportunity, meaning the AI product that's put out for whoever that end consumer is? Or is it all the companies that might be leveraging AI for their own internal things, whether it's drug makers or even finance companies that might start to rely on it a lot more?
It's a great question. So we really see it today on multiple fronts. One is delivering more value to our company's customers. It's incredible the types of applications that are being developed in very short order. Second is in the world of cyber, for example, now the cyber threats are much more incrementally intelligent with the usage of Gen AI, defending those threats with AI. So it's really AI battling AI in this really complex cyber world that we're living in. And the third is driving a lot of efficiency in organizations. We really view Gen AI as an enabler of talent, and we think that what really talented people can do, of course there's a lot of those individuals within the software market in every industry, is fundamentally expanded through this new technology.
I mean, part of what's made Thoma Bravo so successful, and particularly in the technology and software space, is the ability to properly value a potential deal. How difficult is that right now? Because there's so much hopium, there's so much hype around AI that, at least from an outsider looking in, it's hard to know what's sort of substantive and what is just kind of that sizzle. So how do you come to a proper valuation when it really is just trying to be modeled out like 30 years into some future that nobody really knows what it's going to be?
In the world that we live in and operate in, for us, it's much more about what the company will do and how it will perform over time, how much cash flow the business will generate. Within all of our companies, which are very established, very innovative businesses, you're right, there is a component always of innovation, and we need to be partnered with those businesses that are the most innovative. And so we look at this new capability that the company has, and it is table stakes to have a strategy around Gen AI today, but it's part of the overall business. And so for us, at the end of the day, it's much more about company performance than about over the long term than it is about evaluation at a given point in time.
Well, that's interesting, because if we're thinking about Gen AI and its real impact is maybe a decade in coming, or it's going to take multiple years, how much of a runway are you going to give a company when you look at investing in something? Like, are you willing to kind of pay up in terms of multiples with the expectations that it might take 3 years, 4 years, 5 years, or longer?
In the businesses that we are investors in, of which we generally are the control investor, these companies always have a segment of their development budget that's very, very forward-looking. So it's a combination of what we're doing today and also looking in the forward. You always have to be funding that innovation cycle. Customers want it. It's exciting for employees. And today, the big difference with this new technology that really has come to the surface in the last year, it's usable today. Products are being delivered today to our company's customers, and the payback is actually relatively quick.
Can you shed a light into exactly what companies are doing with all of this? Because I feel like some of Gen AI is going to be somewhat mundane tasks, but they're now, done by software or whatever. Like, give us an idea, right? In terms of the broad macro, we get it. Like, it's going to change a lot of things and processes. But what specifically? I'm curious about some of what you're seeing and how it's playing out.
Yeah, you're right. I mean, today, what you're hearing a lot about and what you're seeing is that larger organizations are able to use the technology really to drive efficiencies in their organizations.
Like back office and things like that?
Back office is a great example. The way we think about it in the world that we're living in is that it's an incremental value to our company's customers. So it really makes the products that our companies are building and selling much more usable in new ways to more members of an organization. We're really optimistic about it as a use case. In cyber, it provides our company's customers the ability to prevent threats and detect threats much quicker. And anomalies much quicker. And it's an extension of already what's gone on in machine language for really the last decade.
Seth, I want to ask you a little bit about just the broader private equity space right now, particularly in the context of regulation. There's been a lot of rumblings in Washington about some of the strategies PE firms have taken. Roll-ups, of course, have been kind of a staple of that. And the idea that at least certain folks in Washington want to sort of clamp down on that. How in tune are you right now with some of those regulatory winds circling, and how much of that is going to force you to maybe rethink some of the strategies that you've taken in the past?
I think certainly we're in a different regulatory environment than we have been in the past. For us, we're operating in markets that are just so huge and enormous, with a lot of growth ahead of it, and that are very fragmented, that it's certainly something that we're thinking about, and that of course you have to. But it's not something that's taking up a lot of our time on a day-to-day basis as we're making new investments.
Does the election change that, maybe? The regulatory environment?
Your guess is as good as mine.
But could it, in terms of the outcome, you think?
It could potentially. There could be. I think every time that there's a change, right? There is certainly a change in regulatory environment. We don't plan on that. We don't try to predict that ever. It's just part of the landscape today, and you're right that the landscape today is different than it was in the past.
Do you have another question, Carol? Because I want to pivot to sports for a second. All right, I got to ask you about the Ottawa Senators. There was a lot of mystery behind the purchase of the Senators a few back late last year.
Tell us what you're doing.
And Bloomberg, of course, was out in front reporting that you were behind that bid here.
Are you?
So I am part. I grew up in Ottawa.
Yes.
I am a lifelong hockey fan.
And
I played hockey my whole life.
Yeah.
And I'm very passionate about it. And I am part of the ownership group of the Ottawa Senators. But I am certainly not the controlling shareholder in the Ottawa Senators.
Well, still, that's got to be like a childhood dream come true, even to have a minority stake.
It's an incredible amount of fun and something I'm very passionate about.
Yeah.
Seth, thank you so much.
Thank you so much for having me.
Really appreciate you stopping by. Seth Boro of Thoma Bravo joining us here.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Now, commercial real estate, really the talk of Milken this year as of last year, with roughly 20% of the $4.7 trillion in U.S. commercial mortgages held by lenders and investors coming due this year. It's the reason why everyone's talking about it. I might create some pain out there for some folks who need to refinance, but it has lured a slew of investors armed with hundreds of billions of dollars to target commercial real estate deals. One of the most active players is Hines, which last month announced a new platform called Hines Private Wealth Solutions that seeks to capitalize on some of those troubles in the real estate industry. David Steinbach, the Global Chief Investment Officer at Hines, joining us right now. And it's got to be one of the biggest opportunities you've seen in your career.
Yeah, these only come around a few times in your career, and we definitely have a moment where there's going to be real opportunity. So it is exciting to see kind of what's ahead this year.
But how do you sort of cut through all the gloom and doom? No one's going back to the office. None of these buildings can be repurposed. How do you look at that sentiment and then look at those properties and decide there's something of value?
Yeah. So Hines is a global investment manager. We have about $100 billion under management, and we're in about 30 countries around the world. So it's a pretty unique perspective in terms of seeing real estate through a global lens. And I'll say it's not the same everywhere in terms of just different dynamics, not only macroeconomic policy, but also physically what's going on the ground in different places. And so even the experience of office has been very different around the world in the last few years.
Let's go around the world. Let's start with the U.S. property market and the office space. Your exposure, what are you seeing? Is there going to be another shoe to drop?
Yeah, look, I think it's important to remember that what's happening right now is really 2 years in the making since interest rates started going up, right? So we're over 2 years into that. And so what this has felt to me has been a lot more of a controlled, managed process. Certainly there's a lot of pain in the system, but people have had time to work through the issues. And so I think time has been the key ingredient here to finding a way forward. So what we're doing now is much more looking on the horizon for what's ahead and where those opportunities are. Certainly there's a lot of things that need to get fixed still. I think private credit is a part of that, but I know equity is going to be part of that solution as well.
David, having said that, people talk about some of the office properties in like Midtown Manhattan and the Garment District. Nobody's going to ever want them in terms of office space. Will they have to be, like, what do we do with that? Some have said maybe the government needs to come in to help kind of clear some of that out. Is it fair to say that there's going to be office space that never is going to be used again? Yeah,
sure. Office is a big sector in the United States.
Yes.
And there's a lot to that, right? I think what first needs to happen, and I think we're going to see it this year actually, I think we need to see some transactions in the trophy space. So the best of the best, we need to see some real trades and have price discovery there. And I think that will be a huge signal to the market once we really start seeing that. Right now, I mean, we're in conversations with people where there are discussions. There's still a bid-ask spread. I think that bid-ask spread will close this year and we'll finally start to see some transactions. And that's what the market really needs to understand how to price the sector.
So does that mean, yes, there will be some properties that will just never be used again, office space?
Yeah,
in New York?
Yeah, just like in the retail sector, 15 years ago. I mean, there's certainly going to be some things that aren't going to be repurposed heavily or torn down. But I know that there are high-quality office buildings where the rents are performing, the fundamentals are there, but the capital markets are not.
Yeah.
And so what we need to see is the transactions to be able to have some certainty for how to price the rest of the space.
As far as your investment strategy, do you take a hard look at the properties that need to be repurposed, or are you primarily sort of focus more on those ones that are already set to go?
Yeah, look, I mean, a part of our operating model is really tapping into what we see as a much bigger change in real estate investing right now. I mean, there's regime change in interest rates, and it's going to be a different world. The way I've described it is the last 40 years, it's been downhill skiing in terms of a sport, and it's going to be cross-country skiing for now, probably for quite a while. And so I think that, in that new sport, it really is a new sport. It's a new mindset, a new muscle. And I think there's going to be a real shift from a search from beta to a search for alpha.
Yeah.
And that alpha generation really is that local execution. And it takes a very clear-eyed view on what office or whatever the real estate product is and what's going to make it work and what's going to make it work in this new era of investing.
Cross-country skiing is really hard. I don't know if you've ever done it, but it's
hard work.
Yeah. I was going to say with climate change, there isn't a lot of snow out there, so it sounds like it's going to be a little rough either way.
I am curious. I mean, we all kind of are aware of the issues in the U.S. commercial real estate market.
Right.
You have an international footprint here.
Right.
Kind of compare and contrast that with what's going on overseas.
Yeah. Look, I mean, it's definitely, it depends on where you are. So last year, certainly Europe was leading the recovery in many ways. There was more transactions. There was more pricing discovery points for investors to get comfortable with. But we're seeing opportunities still in Europe. Our business is pretty balanced. Last year, we were about a third in Asia, a third in the U.S., third in Europe. I think the U.S. will now be more of our business this year. And we're certainly going to chase that. And in Asia, there is a lot of opportunity. In Japan, Australia, build to rent is a significant investment theme we see around the world. The United States is about 3 million houses short. That theme is elsewhere as well, and there's real reasons for that. And we think we can help solve some of the problems and bring new product to a lot of these countries.
Greater China, you've been there since 1996. What can you tell us about the real estate market in Greater China right now? And the government, do they ultimately need to do something to move this along finally?
Yeah, look, it's definitely been a tough situation, and we do have a presence there for a long time. We're still there. I'd say we're very cautious and being very careful, as everybody would be. We've actually begun to focus a lot more in India the last, let's say, even 24 months. And India has been a huge area of growth for us, where we see a lot of expansion plans for a lot of U.S. companies, frankly, are setting up a lot of a deeper presence there. So that's been a significant pool of opportunity for us.
Do you still want to have a presence in China, Greater China?
I think, China's going to be one of the largest economies in the world. I think it's just a matter of what it looks like. We're still there. But we see a lot of opportunity in the entire region, frankly, and all of that region feeds off of each other in terms of how the broader economies work.
What is the price discovery and price transparency look like over there right now, though?
In Asia more broadly?
Well, specifically in Greater China.
Yeah. Look, I mean, it's like a lot of other, even the United States, there just hasn't been a lot of significant trades yet for the trophy type of assets. So, but that's the same thing in the United States. We're waiting for that. Like I was saying earlier, we're waiting for that as well.
But are there distortions, like government sort of distortions, given how much involvement they have in the property market?
Yeah, look, I mean, within the Chinese economy, certainly the local Chinese insurance companies, there is a lot of local capital there that I know a lot of sponsors are looking to now to backfill where international capital was. And so certainly within that context, there is capital and liquidity.
David, you have a massive team, a massive presence, and you see so much. You mentioned India. I think that's really, fascinating. If you had to pick one market globally where you're like investors, I think about the Bloomberg audience, that keep an eye on, is it India?
I think, yeah. I mean, look, India is a place of dramatic change, without question. And we're putting a lot of resources around it. We have a lot of opportunities that we're unlocking. But I see opportunity everywhere, honestly. And like I said earlier, the United States, to me, I think is going to be where a lot of investors focus most on. It's probably where we're going to see the most transactions.
In the U.S.?
In the U.S.
Next 12 months?
For the next 12 months. The next 12 months, yeah. And I think it'll start with credit and move into equity. And so I think that's how investors are looking at it.
I have to ask you the interest rate question, the Fed question. We came into this year with expectations we were going to get multiple rate cuts. People are still holding out we get something. How much of your business right now would be dependent on a meaningful shift in interest rates, whether it goes down or up, for that matter?
Look, so one data point, if you look at the last 17 election cycles, what did the Fed do? About 2/3 of them, the Fed actually raised rates. Only about 6 of them, the Fed lowered rates, and 1 of them it held steady. So it's interesting knowing you see the patterns, right, in terms of like where past elections were. So I would say the Fed is likely going to take the right view for the economy. And whether or not rates have gone up almost 500 basis points in our business the last 2 years, whether or not there's a slight cut, it's flat, even slight up, it's not going to matter that much in the scheme of our total business relative to where we've been. So we're much more focused on how do we create income, how do we create value, how do we make the right investments today for a long-term horizon, because real estate is a longer-term horizon investment. So it's 5 to 10 years is often how investors are holding it, and so that's how we're underwriting it right now.
It's fascinating. David, thank you so much, but I just feel like so many of our guests here at Milken have said a little bit higher, a little bit lower. It really doesn't matter. This is kind of the environment we're thinking we have to operate with.
Right. Yeah, I mean, the other analogy I thought of, it's almost like car racing, right? So NASCAR, the economy is like we were on NASCAR. We're just going around a circle really, really fast. Now we're shifting into F1, where we just don't know what's around the corner, but we're still going really fast. Yeah. And so I think it's a new sport to play, and I think in this market we just have to be a lot smarter about how we're going to navigate whatever corner might be around the corner. So.
All right, well, we're going to have to leave it there, and you're so smart, David Steinbach, the CIO over at Hines.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to get back to the markets because we've got a great indicator of what is going on in the financial and business environment. It is through the world of restructuring and turnarounds. And we've got a great voice on that. With us is Lisa Donahue. She's AlixPartners, co-head of Americas and Asia, joining Romaine and myself here at Milken. Welcome. Nice to be talking with you.
Great to be here.
I do think this is a great indicator, right? We look at different metrics about the business environment, what's going on more broadly. What are you seeing and what does it tell you about the macro?
We're talking a lot. We see hundreds of companies. We work with C-suites, executives, and what we're seeing is forward-thinking leaders are getting prepared. If you think about CEOs in the C-suite, they've been dealing with disruptive forces for years now. COVID, ground wars, technological disruption. A lot. So forward-thinking leaders are thinking about flexibility, agility, how to take some of these challenges and look for the opportunities in them.
Lisa, there's big forward-looking, and then there's the cumulative effect of a great financial crisis, a pandemic, disruption. Having said that, are more companies in trouble? Are they looking to do restructurings and turnarounds?
I think more companies are trying to think smartly about how to operate in this high interest rate environment and how to deal with whether it's a capital R recession, small R recession, but really changing consumer behavior. And if you think about some of the economic drivers of certainly the U.S. economy, it's the consumer. So thinking about if that starts to be a slow trickle, what management teams can do to get ahead of that and to be prepared and to think about how to pivot and think about how to react.
And also the whole issue that what's ailing the economy, if you will, isn't just cyclical. There are structural changes as well. So I would think that means as a corporation, you have to take a structural look at your business, whether that's divestments or acquisitions or whatever, or a complete turnaround here. What type of questions are you getting on that front?
You know, that's an excellent question, and you hit the nail on the head. We're working with so many executives on what should their business model look like? What should they be doing to be kind of fit and ready, fighting ready when more disruption comes? We're talking a lot about carve-outs. We're thinking about what 5 years ago may have made sense as part of your conglomerate. Now it doesn't, and what isn't great for you may be a jewel for someone else. We're looking at customers. I mean, the simple truth is all customers aren't created equal. Is it time to fire a few customers and take a look and really understand full-on cost to serve?
Yeah, and on that point, though, as these companies sort of make these assessments here, there's this idea that what's happening now is kind of slow moving, at least relative to, say, the global financial crisis, some of the big sort of shocks where all the pain kind of happened at once. Do they have a bit more of a luxury of time on their side this time around versus past crises?
You know, I don't know that I'd call it a luxury, because I think the C-suite of today is dealing with faster and faster change. We're dealing with two ground wars, the emergence of more accessible AI. I mean, the truth is AI has been around for over a decade, but when you think about what ChatGPT means in some large language models, what a lot of our companies are thinking about is, how can I use that? How can I use that to be more efficient? We're working with a very healthy company, and what they're trying to think about is, how do I use customer fragmentation? How do I use to enhance the customer experience? Target the customers in the right way, not in a robotic way, but in a human, authentic way. So there's some really cool things, I think, coming out of AI. And again, I go back to the forward-thinking executives, the executives that are thinking, okay, this may be a little rough sledding, but I'm going to be ready for it. I'm going to be lean. I'm going to be forward-thinking. I'm going to think about opportunities versus just crisis.
So, Lisa, one of the featured speakers was, of course, last night, Elon Musk. He did not talk about Tesla.
No.
We waited, but it didn't happen. But you are seeing something when it comes to the electric vehicle space. Give us an idea, because it does feel like, yep, there's still growth, but it's at a slower pace. What are you seeing?
You know, we do a lot of thinking about energy transition and what that means, not just for electric vehicles, but across the whole electric grid. And I think one of the biggest indicators of maybe a little bit of a slowdown. I think everyone knows where we want to go, and everyone knows that ultimately we're going to get there. The question is, how long does it take? What are the steps in the interim? And in my mind, what is the required infrastructure to support it? And you think about what happened with Hertz and the pullback on their electric fleet as a result of the primary market prices going down, which then, of course, affect the secondary market prices going down. And maybe the consumer wasn't quite ready for longer hauls, not feeling comfortable with the charging stations and understanding what the infrastructure looked like. I think we're still getting there. I think we will get there. I think that the hybrid is the now, and the EV is the future.
But are you doing restructurings and working with companies that kind of need to reset their metrics in the EV space?
We're working with companies that are trying to think more broadly about, from a macro perspective, what's happening and what does that mean to me, and importantly, what does it mean to my customers and my competitors
in that space.
In that space, but honestly, energy transition impacts all of us. So it's not just uniquely that space, but in that space, helping them think through how to be more efficient, how to, again, speak to the customers, and then what that transition means to you as a CEO, as a C-suite executive?
Another big change that's been going on over the last few years is the refocus on supply chains.
Yes.
Obviously, here in the U.S., we had the big disruptions globally, we had the big disruptions from the pandemic. There's been a big push to nearshore because of trade wars and other geopolitical issues here. Is this going to also potentially be, I guess, a new avenue of business or an expanded avenue of business for you?
One of the things, as you know, you mentioned that I focus on Asia as well. And I've spent, in the last 18 months, I've been there 5 times across China, Singapore, Tokyo, et cetera. And there's a couple of things that we're seeing as it relates to supply chain. Number one, and I get asked this question a lot, I don't think that we're going to be deglobalizing and moving completely away from China. We're too interconnected. It's too big a market to ignore. But what I am seeing is a lot of large global manufacturers are thinking about redundant supply chains. They're thinking about keeping what they have in China and looking at Vietnam, Japan, and Mexico has been a huge beneficiary of that type of movement. But I think, and what we're seeing and what we're working with folks on is, yes, it's about cost, but it's only about cost. It's not only about cost. It's about surety of delivery and making sure that you actually get the piece so you don't shut down your manufacturing line because of uncertainty with a long supply chain.
Yeah, fascinating. I do think about, though, the redundant costs of maintaining those supply chains, especially when you bring them back home.
Yeah, but some of them, they have no choice to do that, right?
Absolutely.
And I think to Lisa's point, the idea that it's more than just the initial financial cost, right? It's the longer term.
The pandemic showed that too, and some of the technology battles or the geopolitical battles that we are having. Lisa, great to get some time with you.
Thanks.
So appreciate it.
Great to see you guys.
Thanks. Lisa Donahue, she is a co-head of the Americas and Asia at AlixPartners.
Yeah, and then she brought up Mexico too. I mean, we've seen we have to do a whole show on that because I'm fascinated by that and how much has been moved back towards the border. And remember, we went through this before back in the NAFTA days, and then it kind of died down a little bit.
We recently caught up with the architect Gensler, and they are global, and they talked about all of the activity and facilities that they're building specifically in South America, Mexico in particular. So it's happening.
Absolutely. Will you be around for that show too, or do I need to check with Tim?
I don't know. Let me think about it.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.